Welcome. Today is Friday, March 17th, whirlwind week in the market once again. And of course, the banks are at the top of the list here with SVB, Signature, and now Credit Suisse heavy in the news. So let's get back to kind of what's been going on, particularly with the SVB situation. What we found here is that when banks get our deposits, they invest them in different ways, of which one of the ways might be a long-term U.S. Treasury bond. So a Treasury bond is essentially a loan to the government. And so let's say January of last year, you decided to buy a 10-year Treasury bond. You might have gotten, if you were lucky, a 1% interest rate. So you buy the bond for $10,000, you get your 1% per year, and at the end of 10 years, you get your money back. The U.S. government has never defaulted, so it's considered a pretty safe investment. Now, inflation was going through the roof, and the Fed decided we're going to combat that by raising rates. So the 10-year bond got as high as a 4% interest rate. Now let's presume I wanted to buy a bond and you had a 1% bond, but I can go buy one on the street today paying 4%. Well, I don't want to buy your 1% bond. I want to buy one of these new 4% bonds. So if you had to sell that bond, you would have to discount it. Maybe sell it for $9,000, $8,500, that $10,000 bond. That's a big discount. So that's why you will see the value of bonds drop, even though if you hold them to maturity, you should get your money back. And that's essentially one of the big keys here is that the underlying assets that the bank were holding were in some of these longer maturity bonds. So that's what's causing some of the issues there. We'll see what happens ultimately. Looks like the government has come in to save the day, but just wanted to give you a quick update on what was going on.